I think we're going to start talking about deflation more and more. And I believe interest rates are going to come down more than people expect until this productivity-driven boom is obvious.
If we get deflationary forces or get actual deflation, is that bad for Bitcoin in the short term? All right. Let's start with inflation and deflation. One of the things that's interesting to me is I've been talking about, deflation is a bigger risk. I see you tweeting about it. So you're, in spirit, we are locked in this together. What is your read on why deflation is a bigger risk?
So it's a risk and an opportunity. So there's bad deflation and good deflation. If you look at the government measures, they will tell you today we're kind of stuck in this 2 to 3% range. If you look at a more modern indicator, trueflation, I think you feature it as well, Anthony. I don't know if I should call you Pomp or Anthony, but anyway.
Call me a Cathie fanboy.
Oh, you're funny. Thank you. So trueflation is down to 0.8%. And so it too was stuck in that 2 to 3% range. It is resolving to the downside. And I think it's going to go negative. When I see Pepsi, cutting the price of potato chips and Doritos by 15%, I take note. And when I hear Coke saying, yeah, it seems like there's a bit of a backlash against price increases, I take note. Today, the existing home price inflation rate dropped to 0.9% on a year-over-year basis. And we think that's going to go negative. New home prices are already falling on a year-over-year basis. Gasoline prices falling. And then the good deflation is associated with technologically enabled innovation. And the AI boom is massively deflationary. The AI training costs are dropping 75% per year. AI inference costs, so what it costs when you query ChatGPT or Grok, what it costs to answer that's dropping 85 to, if you believe DeepSeek, 98% per year. And I think the productivity gains that we are seeing accrue to enterprises, that is going to turn around in a number of ways. One of them could be price declines. So many people think, these corporations are going to simply increase their margins. Well, China is exporting deflation. I know with tariffs, we're countering it, but isn't it interesting that our inflation rate did not accelerate with tariffs? It remained stuck. I think we're going to see a lot of price declines in the future.
When you think of the AI explosion, I think it is operating obviously in this complex environment. So you have deregulation, you have tax cuts, you have deportations, you have the AI boom, you have a global monetary reset where we are trying to weaken the US dollar. You have the tariffs. You kind of put all this together. How important do you think is it that the president, the Treasury Secretary, and the Fed chair nominee all seem to be, on the same team? Seems like they are going to go and implement this plan, which means that for investors, maybe it's going to be a little bit more of a complex environment to navigate in the coming years as we go through this kind of reset.
It's so interesting. Many people are asking, is this just a hype cycle? And, should we pull away? I don't know if you've seen the markets in the last couple of days, but, now algorithms are assuming that AI is going to destroy industries wholesale. This is not what happened during the late 90s. And I will get back to your question. In the late 90s, when Jeff Bezos said, we're going to invest so much more than we expected because this opportunity is so great. And that means we are going to lose so much more money than you, shareholders, expected us to lose. The stock absolutely took off to the upside. Any company saying that today is getting hammered. So we are in a completely different environment. Your question was the various parts of the administration being united. You mean when Kevin Warsh comes on board? Right now, of course, Powell is not at all aligned with Trump. You mentioned dollar devaluation. I don't think that's what's going to happen. Treasury Secretary Bessent, who knows all about currency markets and knows how important they are, is saying a strong dollar is in the interests of the United States. Now, many people look at what happened last year. The dollar went down quite significantly. But if you look at the dollar in a long-term context, just go back to the early 70s and see where we are now. You'll see that the dollar, again, this is relative to other currencies, not relative to gold. The dollar is at closer to the upper end of the range, with the exception of the 85 blowout of the dollar, than it is to the lower end. And I think the policies of this administration suggest to us return on invested capital here in the United States should go up relative to that in the rest of the world. What do I mean by that? We've got massive deregulation. This government understands how much we have hurt ourselves relative to China with thickets of regulation, and they're trying to peel those away as quickly as possible. We got a tax cut where for the first time in our tax history, for the next 3 years, as long as the construction of a manufacturing facility starts by the end of 28, during its first full year of, or during its first year of service, the company building that facility will be able to depreciate it not over 30 to 40 years, but in the first year. So massive tax refunds coming back to reinvest. Where we are seeing tax cuts for the consumer to some extent, certainly at the margin, in, tips and, overtime, Social Security, and autos. So, I think we're going to see massive refunds here in the first quarter. And I think that, the rolling recession that we've been in for the last 3 years, PMI being down negative, for saying manufacturing's been negative for the past 3 years. We've seen housing and got a terrible number today, 3.9 million. We're back to the lows in existing home sales. I think we are going to shift from that to a rolling recovery into a productivity-driven boom. And I think one of the things that is becoming obvious when you look at how they revised the employment numbers down by 860-something thousand over the last year, if in doing that, what they effectively said was, okay, given this level of GDP, and we're more sure about GDP because of national income accounts and so forth, it must mean that productivity was higher last year if we revised employment down like that, which in turn means that real GDP growth was higher and inflation was lower. They got the mix wrong in the GDP accounts. I think we're going to start talking about deflation more and more, and I believe interest rates are going to come down more than people expect until this productivity-driven boom is obvious. So I actually think the U.S., from an investment point of view, is going to do very well over the next few years. You wouldn't know it from the last few weeks. But I think that we're in the flip side of the bubble. We are absolutely in the flip side of the bubble. Investors just threw money at the bubble when the technologies were not ready and the costs were way too high. Now we're in an environment where we're ready for prime time with all of these technologies, robotics, energy storage, AI, blockchain technology, and multi-omics technology. And so I think we're going to have a boom, and the U.S. is going to do very well.
Today's episode is brought to you by Fountain Life. Are you ready to seize the day that will change your life? Guaranteed. You invest in wealth creation every single day, but what's the point of it without an optimal health span? Award-winning Fountain Life is the world's most advanced longevity destination. And in just one day, they can map an exact and complete picture of your health profile. No guesswork and no blind spots. From there, they create a personalized plan that prevents disease and may even reverse aging using precision medicine and restorative therapeutics. It's available nowhere else. In other words, your energy supercharged, your memory sharper, your life extended, and so you can live without limits. It's the best investment you'll ever make. Receive $1,000 off the cost of a life-changing membership with Fountain Life when you schedule a call at fountainlife.com/pomp. That's fountainlife.com/pomp. Today's episode is brought to you by Figure. My friends at Figure are giving away $25,000 in USDC as part of their democratized Prime sweepstakes. Here's how it works. From January 20th through February 20th, Figure is awarding one grand prize winner $20,000 in USDC, and then 5 additional winners will get $1,000 in USDC each for a total of $25,000 in prizes. To enter, all you have to do is download the Figure Markets app using my link, and you can deposit funds into their democratized Prime lending pool. Every $1 you deposit equals 1 entry. So if you put in $10,000 and leave it there for 25 consecutive days, that's 10,000 entries. And if you take it out before the 25 days, no entry. Simple as that. Now here's the part that really matters. While your money stays in democratized Prime, it can also earn up to 9% APY, paid hourly, which is something almost no one else in the market is doing right now. You can earn yield while getting a shot at winning meaningful USDC prizes. This sweepstakes is US only, it's limited to 25,000 total entries, and it's only open to people who have never matched an offer in democratized Prime before. If you want to earn competitive yield and enter for a chance to win $25,000 in USDC, download the Figure Markets app using the link in the description and deposit into democratized Prime today. As always, make sure you do your own research and understand the risks before putting capital to work. Go check out Figure and their democratized Prime sweepstakes today.
If we get deflationary forces or get actual deflation, is that bad for Bitcoin in the short term?
No, I don't think so. Bitcoin is a hedge against inflation and deflation, because the chaotic part of this is, and it's ripping through the markets now. A lot of traditional industries and companies, being brought, the whole SaaS space, the disaster, as they're calling it. We think there is merit to that particular one, but I think you're going to see disruption all over the place. Because the 5 innovation platforms that I mentioned are going to disrupt the existing world order. And what does that mean? If these technologies are so deflationary, it's going to be tough for the traditional world that's gotten used to sort of the 2 to 3% inflation, to adjust. They'll have to embrace some of these technologies faster than expected. So the idea of counterparty risk, I think, is beginning to surface. We've seen it with First Brands. We've seen, private equity and private credit, especially, is where there have been a lot of excesses. SaaS, they are too exposed to that. Are we going to see counterparty risk manifest more broadly? If so, Bitcoin doesn't have that problem, and so it is a good hedge against deflation as well as inflation.
As a proud Tesla shareholder, I'd love your thoughts on Elon, XAI, SpaceX combination. Do you think he's going to combine it with Tesla? How you look at all the work that he's doing?
I think that ultimately he could, and he started. We have been using the word convergence for a long time. I'll give a plug to our Big Ideas 2026, and you'll see a section by Brett Winton, our chief futurist, called The Great Acceleration. And you'll see a sphere in there showing how all these technologies are converging one with another. And at one point in the last, I'm going to say 6 weeks, Elon said, you know what? I think my companies are convergence stories. So we thought it was interesting he used that word. So SpaceX XAI does not surprise us at all. I think he's going to let Tesla run here for a while, because the robotaxi revolution is just beginning. And I do think he wants that story, to become very clear to investors. And it will. He doesn't want to, combine with anything and confuse what's happening here. And as you know, we have very big expectations for robotaxis. We love it that Tesla and Waymo are competing against one another. And we think, the stock, Tesla stock, if you look at it, it's been in a very large trading range for the last 5 years. And I remember the last time I said that was when Tesla was going through manufacturing hell, and there were people out there saying Tesla's going to go bankrupt. There's no demand for these things. It had been in a very wide range for 6 years back then. And I said, the history of long bases like this is they either break out or break down. And we very much think Tesla's getting ready to break out again. And then Elon will have more degrees of freedom.
What are you worried about in 2026 from a portfolio standpoint? What are the things you're paying attention to, and what could potentially change your mind on some of the allocations that you've made?
Yeah, what's happening in the last week or so in particular reminds me of the early days of COVID. Nobody knew what to do. And so algorithms just sold everything off except for, the safest stocks, the most cash rich, and cash flow generative companies. And I remember as I was looking at it, it's an algorithmic move taking place in the market and causing a bit of a downward spiral in innovation-related stocks. Now, unlike COVID, we're probably not going to have massive fiscal stimulus in the way that we got back then. So we're not going to come out of this with a big boom. But they're selling the baby with the bathwater again. And so it gives active managers an opportunity to, in our case, concentrate towards our highest conviction names. I think the biggest risk out there is that Powell, who will only be in place until May, that Powell is not, and the other Fed board members are not understanding the deflationary undertow that is beginning to take place here. And they will not, because they're not looking at the right signals, and because they're looking at government data, which is all, wrong and based on the industrial age, they could miss this and will be forced into a response when there's more carnage out there. I think that's what I'm worried about right now. I think this is the opposite of the bubble, tech and telecom bubble. Right now, we're seeing all of the beneficiaries of AI, and every stock in our portfolios we have been looking at through the AI lens for actually the last 5 to 10 years. And so we believe we have the beneficiaries in our portfolios. But there's so much confusion out there on AI that, it's baby out with the bathwater, as I just said. And then you have this overlay of the policymakers once again being late. A lot of people in the crypto market and in our markets are technical analysts, and they use the 200-day moving average, 200-week, and they see it break. So, there's an algorithmic, technical move taking place here. And, as I always say to our team, truth will win out. And we definitely are on the right side of change. And we believe we are in the right companies, that will, benefit mightily from not only the AI revolution, but the convergence among these technologies. When you think about the way traditional research is set up in traditional asset management, it's set up incorrectly to understand what's going on here. It's set up by sector or industry or sub-industry. Many companies have 5 healthcare analysts, 5 consumer analysts. In the world of innovation, the right way to look at the world today is by technology. Involved in those 5 platforms are 14 different technologies. We have set up our analyst responsibilities, by technology. So they are experts in a given technology, and they are generalists when it comes to sectors and industries, because these technologies are converging, and they are going to impact every sector, every industry, every company.
Cathie, you got me pumped up here. This is amazing. All right. Well, we appreciate it very much. Keep doing what you're doing. Everyone here is missing you, but next year we're going to get you in person. So thank you so much.
All right. Thanks so much, Pong.
All right. Bye.
Thank you. Bye-bye.